Businesses in Kenya are facing the pinch of high interest rates of between 24 to 27%, as commercial banks are now advising business people to postpone borrowing. CNBC Africa's Charles Gitonga tells us why motor vehicle importers are some of the businesses taking the heat of the high interest rate regime.
Kenyan businesses are in for a tough fourth quarter of the year as interest rates skyrocket to a high of 27%. The interest rates are responding to reviews of the benchmark lending rate by the Central Bank of Kenya from 8.5% in April to 11.5% at the moment.
I think the point I'm suggesting is that the movement is not smooth. So you suddenly have an increase after 3 months of waiting, and then suddenly everything jumps. And it then kind of jumps dramatically. So we increased by 300 basis points, and you can see that interest rates in those particular those interest rates that I just now mentioned went up by more than that, much more by that. So you could say they have overshot.
And while the motive behind the rate hikes is to cushion the Kenyan shilling, which has depreciated by 14% against the dollar this year alone, businesses have to bear an interest rate above the 22% Treasury bills rate.
Interest rates of 21% and 22% on Treasury bills mean that has been set as the risk-free interest rate. That is what basically the commercial bankers are interpreting, that the central bank have said this is risk-free, so if you are participating in the commercial world, you must charge slightly above that. If you charge below, let's assume a client is charged 20%, people like economists will just come to the bank, pick the money at 20%, and place it with the treasury bills, which are risk-free, and get a 2% arbitrage in interest tax. That explains why commercial banks lead the direction of interest rates from treasury bills.
Motor vehicle importers are finding themselves at crossroads. On one hand, the high interest rates are inhibitive for business, yet on another, the rates are expected to ease pressure on the Kenyan currency.
We're just like any other finance person waiting and watching to see what the market will be like. Because with the weakening of the yuan and the gaining of the US dollar or the US economy strengthening, this situation, we do not know how long it will last unless the US government raises interest in their, like Kenya has done, interest on their loans and other investments in their country. The dollar will continue to strengthen as is predicted, and so we expect also the same for the Kenya shilling to continue being affected. Now, the only cushion we can give to our people, not based on the monetary, but based on the banks locally. If the banks can probably extend the loans term.
In the meantime, some commercial banks are advising businessmen to postpone projects that require them to take up loans.
Most astute business people will postpone their borrowing for the time being. They will not engage at interest rates of 24 because they are high. And lastly is that there will be some strain in terms of performance of loan book across the industry because of interest rates being that high. However, I don't believe there is anything fundamentally wrong that Treasury and Central Bank will not be able to manage. So I believe that this spike is short-term, and they should be able to bring it under control by March of next year.
However, commercial banks and businessmen alike are pegging their hopes on the actions of the central bank to control currency volatility while ensuring affordable cost of money.
The first thing I see is a strengthening of the Kenya shilling. It has so far strengthened from 107 to 102, and I see today in the Business Daily a prediction that with the current interest rate, it will be just a question of time before it comes below 100.
I think the current central bank governor, just like the one before him, predecessor, is trying his best. And the wait and see the central bank is doing, because if they intervene, then the volatility continues to increase, the speculators continue to speculate. I think we've seen a steady hold for the last few days. I hope it will stay, because it will help us a lot. And we hope that to some extent, because we do a lot of imports on oil and other stuff, consumptions here, that our economy is going to be sustainable in terms of inflation, that oil prices will continue to go down. If they go down, at least they benefit us from high increased cost of transport and cost of purchases abroad using the dollar.
What we intend to do is to engineer a soft landing of these rates. I think that is what I would suggest. And we do not want a hard landing, meaning everything coming down, you know. So you could think of driving, and there you are going, you know, your foot flat out on, I mean, you have the pedal to the metal, you know, so you accelerate all the way down. And then the next thing is you jam on the brakes, you know, all the way. So you're driving somewhat in a chaotic way, you know. So that's not what we intend to see. We do not want to have that. So what we want is sort of a smooth, gradual decline.
The soft landing of interest rates in Kenya might, however, be interrupted if the US Federal Reserve implements the planned rate hike by the end of the year.
Should things get much worse, should the volatility in the market, should the interest rates really continue to go up, the shilling continue to fall, when the Fed takes more action, then we still see the economy still doing much better at 5.4%.